Hello and welcome, everyone. If you've ever scrolled through Airbnb, looked through those rates per night, and thought, could I do that? Is this a good way to invest my money? Then you're in the right space. This video is your step-by-step beginner's guide to investing on Airbnb. We're going to break down the real opportunities and the very real challenges, so you have a clear idea of what you're getting yourself into. Let's dive in. So firstly, let's define what specifically a short-term rental, or STR, is as an investment. It is not real estate itself. Think of it as a hybrid. You're buying a hunk of property, sure, but you're really running a small, active hospitality business. You're essentially buying a hotel room that you also have to take care of. Legal definition of where you are most places is a property that is rented out for less than 30 days, and that makes all the difference. It is not a passive investment where you just get a rent check every month. It is an active business that requires your full-time attention. You're not just a landlord, you're a business owner. So what's the appeal? Why would one choose to go this more complicated route? 2 words: effort and return. The profit potential is astronomical. Because you can price up on a daily basis, you can capitalize on weekends, holidays, and big local events. This can translate into much higher revenues than a typical year-long lease. But, and it's a big one, this is paired with an immense rise in effort. Industry reports show that a long-term rental can run you about an hour of your week. One single short-term rental unit, 8 hours a week. So you're trading your time for that greater potential revenue. Now, don't jump the gun before we talk about the non-negotiables. Those are the make-or-break factors of any STR venture. First is regulation. This isn't federal taxation with one set of laws. STR laws are more like a patchwork of city by city, sometimes even neighborhood by neighborhood ordinances. We're talking zoning, permits, and special taxes. Get this wrong, and you're out of business, or get slammed with enormous fines. The second is the operational intensity. You are in the customer service business. You require robust systems for cleaning, maintenance, and guest communication 24/7. If you pay no attention to this complexity, you will receive bad reviews, and your business will be unsuccessful. It is that simple. Okay, so with all of those risks in mind, let's establish a solid foundation. In this chapter, we're going to examine more closely how the STR model actually functions and how you would be measuring its success. Let's make the comparison clear. An LTR, or long-term rental, is a stable one. You have a tenant on a year-to-year lease, you get a solid income, and you're dealing with little turnover. It's a predictable, mostly passive cash stream. A short-term rental is the opposite. It's a transactional, high-frequency system. Your guests are coming and going all the time. Your income isn't fixed. It's dynamic. You're constantly adjusting your rate to match demand. It's not stable, but it has a much higher ceiling if you manage it. You can't manage what you can't measure, so in order to know if your STR is working, you need to borrow 3 essential measures from the hospitality industry. The first is the average daily rate, or ADR. It's simple. It's the average revenue you receive per night that was actually occupied. It indicates how well you're pricing your property. Second is your occupancy rate. This is how many of your available nights are actually booked. It'll inform you about the level of demand for your property. And the third and most important by far is RevPAR, or revenue per available rental. Now this is the magic number. RevPAR is so significant because it's the last metric of your success. Get it? ADR only views reserved nights. RevPAR views all your available nights, reserved or not. It balances your pace with your utilization. High RevPAR means that you're booking your nights nicely and commanding a good rate for them. That's the holy grail. What you're doing when you're examining a property is really attempting to forecast what its potential RevPAR is going to be, since that shows the actual income generation potential of that asset. And finally, the highlight, the money. Let us discuss the specific financial benefits which make all this effort potentially worth it. The top financial benefit is price flexibility. With a long-term lease locked into one rate, you can't. You can alter your rates by the day. A Tuesday in February, maybe a discount price. A holiday weekend or a big convention in town, You can increase double or triple. This responsiveness to the market is how you push your revenue. But it won't do that by itself. It requires active management, great marketing, those 5-star reviews, and a smart pricing strategy to capture those peak revenue days. Okay, here's a big advantage that most often gets ignored: taxes. Or rather, the Section 179 election. If your STR is an active business, which, keep in mind, with that 8 hours a week effort, it should, you can apply Section 179. This allows you to deduct 100% of the purchase price of business property in the first year. We're talking about furniture, appliances, even a TV, all of it. But there's a catch. You must demonstrate you're operating a genuine trade or business. So how do you really compute whether a particular property is a good investment? You must create a financial model. Don't fret. It's not as intimidating as it appears to be. Before you purchase anything, you must go through this 4-step process. First, uncover the market statistics. Utilize tools such as AirDNA or Mashvisor and determine the average daily rate, occupancy rate, and RevPAR for your chosen area. Second, calculate your total cash outlay. That's your down payment, plus closing costs, plus all the money you're going to spend on furniture and fixins. Third, calculate your net income. That's your annual revenue minus all your operating costs and your mortgage payment. And fourth, using those numbers, you can compute your cash-on-cash return. Cash-on-cash return is your real estate investing buddy. It simply informs you of your return on a yearly basis, based on actual cash you invested in the deal. It's your net income yearly. So rental income minus all expenses and the mortgage, divided by the amount of cash you invested, down payment, and all upfront expenses. Then multiplied by 100 to give you a percentage. This gives you as clear as day as it gets pictures of your leveraged profitability. Let's make this a reality with an example. Say you buy a property for $400,000. You put in a down payment of $100,000 and spend another $20,000 on furnishing the property. So your cash investment is $120,000. At the end of 1 year, you earn $75,000 in income. Your operating expenses are $20,000, and your mortgage payment is $26,400. This leaves you with a net income of $28,600. You utilize that $28,600, split it up by your $120,000 investment, and you've got a cash-on-cash return of 23.8%. That's a whole lot better than most traditional rentals. But remember, this high return comes with high volatility. You really do need to have cash reserves during slow months or surprise repairs. Now let's pull back the curtain and talk about the one thing most rookies downplay: the hidden costs and sheer demands of running this business. The biggest downside is the time. We quoted 8 hours per week, and that's cumulative. You now have ownership of guest communication, scheduling cleanings, coordinating maintenance, and optimizing your pricing. You are a business manager, and because you have a constant stream of new guests, your facility takes rapid wear and tear. Furniture, bedding, appliances all spoil much faster. Maintenance is not something that happens once a year. It is constant, and it has to happen instantaneously to keep your ratings. This is not passive income. It is a do-it-yourself job. Turnover is the heartbeat of your STR business, and every single turnover is cash and time from your wallet. Cleaning first by professionals. This isn't an option. You need to do a thorough clean between every guest, and that can be $50 to $200 per occurrence. And this is done several times a month, not once in 12. Second, inventory management. You have to constantly replenish toilet paper, paper towels, soap, coffee, all the little things. It's an ongoing logistical and monetary expense. And third, quality management. Every time there's a guest, you or your housekeeper have to inspect really well to catch any broken items before the next guest arrives and leaves a negative review. And let's not forget the platforms themselves. They don't cost nothing. Their charges are an inviolable expense of doing business, and you need to plan for them carefully. On Airbnb, you may pay a 3% host fee, or use a model where you pay 14 to 20%. Booking.com usually takes 10 to 20%. VRBO offers a 5% pay-per-booking charge or a subscription. You need to be aware of these charges on your platform of choice because they directly come off your top-line revenue and literally out of your bottom-line profit. This is the biggest risk of them all, and you have to take it seriously. The regulatory environment for STRs is a definite minefield, and it changes on literally every single street. The compliance isn't over yet with zoning. You're also legally obligated to collect and remit occupancy taxes to your municipality. Sometimes Airbnb will remit them for you. Sometimes they won't. It's 100% your responsibility to get it worked out, or you'll be paying back taxes and penalties. And finally, insurance. Your typical homeowner's policy will not cover you if you rent short-term. They'll reject claims. You need a special commercial STR policy with enormous liability coverage, say 1 to 2 million, and replacement cost on your furniture. This is not negotiable. It's business expense. All right, folks, that was a lot of information, but I wanted to give you an honest, unvarnished look at what really constitutes Airbnb investing. It's not a get-rich-as-fast plan. It's a business with huge potential for reward, but huge work and real risk involved. If you're willing to put in the work and do your homework, it can be a fabulous investment. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.